first of all, we're going to start with the disclaimer. Now, you can read the disclaimer. You can, actually, you can't pause the screen, but you can read that. And let's move on to the topic at hand. Familiar with options probably already know this, but it's extremely easy to lose a lot of money with options. And so I'm cautioning you beforehand, if you have issues with discipline and if you like betting the farm on things, then you probably shouldn't do options. So this webinar, we're not giving you advice. We're just telling you what I do in my own personal portfolio, and I don't do this all the time, but I do use options quite frequently, and I'm going to give you some examples, and then after we're going to turn to the screen to my live Thomson One system, and we're going to see some examples of what I would do today with some options. Now, options are a double-edged sword. Okay, you don't put up as much money, and so you can get some pretty big bang for your buck. Now, that can work against you too. For example, when I make money on options, very often, you know, we can make 30, 40, 50% on our investment, or even 100 or even 200%. But when you lose, you can lose everything on the options. So you have to be careful, okay? You have to understand the leverage factor. If you have $100,000 worth of stocks, it's not the same as having $100,000 worth of options, okay? Every option contract controls 100 shares of a stock. So if you're talking about a stock like AutoZone, which is trading around $700 a share, and you're trading one option, you're actually trading 100 shares of AutoZone. So 100 times $700 US, that's $70,000 for one option. So even if that option is only $5,000, you have a substantial amount of risk on the line because, well, you have your $5,000 on the line, okay? But you can lose all of it literally very quickly. And of course, if it goes the other way, you have some fantastic leverage. So they are a double-edged sword. So be careful and don't be too aggressive. The leverage can really kill you, and I mean that, and I caution everyone to be very, very careful, because options, when you don't follow the plan, when people get a little too aggressive with them, they can really hurt you. And the thing that I've learned over the years is that with options, as with any investments, in fact, I never know which one is going to be the winner, okay? I try to build a portfolio that's diversified, and you never bet the farm on just one thing. So you try to spread your risk out, because you never know what the super performer is going to be. So anyway, you got to follow the same principles with options. Now let's start with some basics about options. First of all, there's two things, and some of you already know this, but a lot of people don't understand options. So you've got basically two kinds of options. You've got calls and you've got puts. Okay, the ones we're usually talking about, in 95% of the time, we're talking about call options, because call options increase when a stock goes up. You have limited risk, okay, but they also decrease if the stock goes down. And when I talk about leverage, I really mean it, that you can lose 100% of your money very quickly. Whatever you've invested in that call option could be worthless. And don't forget, you've got time working against you too, because every option has, first of all, you've got calls and you've got puts, and then you've got strike prices, okay, and then you have time to expiration. And so you could have, for example, an option on Dollar General that finishes in January 2019, and by January 2019, if the stock is not higher than the price, the strike price of that option, basically it's worth zero. So that's how options work. Puts, on the other hand, increase when stock prices go down, and they decrease if stock prices go up. So the important principles to understand here: when you buy an option, you have limited risk and theoretically unlimited gain. When you sell an option, you have unlimited risk and potentially a limited gain. Okay, so we're not often option sellers, okay, A lot of people do what they call naked put options to buy a stock. That's a good idea, but you have to understand that the end game is to own the stock. And I don't want to go into all the details about how these things work because that would be a much longer webinar. This is just an introduction, and I'm going to tell you the basics of how you can use options in some cases to your advantage. So how are options valued? Essentially, you've got three components in an option. One is the strike price. The second thing is the time value. And the third thing is the volatility. Okay, and those three things are all moving parts, and they can change very rapidly. Well, actually, the strike price doesn't change, and the time value doesn't change, but the volatility can change literally overnight and can change the value of that option. So those three components are how you value an option. And when you get an understanding of how these things work, they're not that complicated. Let's take an example. Let's look at Dollar General. This is a stock that we picked up recently, and let's assume that we were buying it at $70, which we were. The purple chips target at the time was $88. If you bought today, and I'm using prices today, okay, the price of the stock is actually $72.85. Okay, remember our target's $88. Okay, so the price today is $72.85. A January 2019 $50 call is worth $24.50. Now, I like buying options that are in the money. Okay, this is called in the money because it's actually got a real value. We call that the intrinsic value. The intrinsic value is the difference between the last price and the actual strike price of the option. So in this case, the intrinsic value is $72.85, the last price, minus the $50 strike price of the call option. So $72.85 minus 50 gives an intrinsic value of $22.85. Now this option is trading at $24.50 right now, and these are actual numbers. So if it's trading at $24.50, but it's only $22.85 in intrinsic value, then the difference, that $1.65 difference, can be explained by the time value and the volatility. Okay, so those two things, if you have more time, and this makes sense, if this same option was a January 2018 call at $50, then that option would be worth less than a January 2019 $50 call. Okay, and I'm actually going to show you this just for fun. I'm going to go and show you what the options look like on Dollar General as we speak. And so this is the picture of Dollar General options. And these are the January 2019. So the $50 call, I was saying, was 24 and change. And you can see where I have my cursor here, the market is 24.10 to 25.60. This is the actual trading system that I have, and it's showing you the 2019, that's the 9 there, Jan $50 call, the C, trading 24.10 to 25.60. Okay? Now, let's go back. No, so remember, about 24.50 is the price here. Now, I'm going to go back to a 2018 option for $50. And you can see, look, it's got a market price of about, it's trading from $22.30 to $24.20. So let's say that it's around $23. So you can see that there's a difference in the time value. Now the stock price is $72.67. Okay, that's the actual live price. So that option has an intrinsic value of $22.67, just like the 2019 option. Okay, they both have the same intrinsic value, but the difference is explained by time value, and in this case, the volatility is the same. Of course, the further you go out, the greater the chance that volatility can get higher. So in other words, an option that finishes sooner has less of those other things on top of intrinsic value than an option that finishes later, that has more time to expiration. So keep that in mind. Now let's go back to the presentation. So yeah, in the example I was using $24.50. So now I think everyone should understand the basics of options here. Now, what are we looking for when we use purple chip stocks, okay? So what's the basic strategy that we want to employ? And I'll tell you what I do. There's many, many different strategies, and people have different opinions about this. You know, some people would say, well, I buy the at the money option, okay, which in this case, let's say Dollar General is around $72, so they would buy like a $70 or a $75 option, a call option. Now that's called at the money, but I don't do those. Those are risky, and they're risky to me because they don't have that intrinsic value that I'm looking for. So I'm always looking to buy something that's so-called deep in the money. Okay, deep in the money means that the option behaves pretty much as a proxy for the stock. So in other words, it's not going to be 100% of the movement, but it's going to be pretty close. If the Dollar General stock goes up by $10, my option, my $50 call, should go up by pretty much $10. Maybe it'll be like $9.75, but I know it's going to be very, very close to what the actual stock moves by. And so that's where you get that leverage factor. Using options can be very, very interesting in place of buying a stock, okay, especially a high price stock. And I'm going to go back to my Thomson 1 here, and we're going to look at AutoZone because this is a good example of an expensive, or not expensive, but a high price stock, okay? So AutoZone, you can see, is around $704, and this is the chart on AutoZone, and you can see that this is a stock that was, you know, it had gone up to $820 about 7 or 8 months ago. Right now it's around $700, and let's go back to the options here. Just a minute. Okay, so I'm back in the options now. So let's figure out what we would buy, okay? The way I look at this, if I'm buying a stock option on AutoZone, which I did, by the way, I actually bought the 2019 $600 calls, okay? And the $600 calls are trading about $150 to $154. The bid price is $150. The offer price is $154. I didn't feel like laying out $700 per share on a stock that doesn't pay dividends. So I thought, why don't I just buy the option? So I bought the January 2019 $600 call. So let's say that you pay $152 for this. Now that option is only worth $103 based on where the stock is right now. Because remember, the stock, 703 less the strike price of 600 gives $103 of intrinsic value. The rest is all time value and volatility. Now, if AutoZone was not a volatile stock, then it would just be explained by time value. But in this case, we have time value, so we've got about a year and 9 months, or a year and 8 months, let's say, until the options expire. And we've got some volatility on the stock. And so that explains why you've got that additional value above the intrinsic value. So I like to look for options where I can basically, based on my plan, double my money. That's kind of the rule that I use when I choose the option. So in the case of AutoZone, okay, we have, I'm going to see what our target is on AutoZone. We have an $820 target. I'm going to go back here. So the $600 option, it's not exactly doing 100, you won't make 100% on this. If you pay $152 for it today, then if the stock hits $820, then your option will be worth, actually you'll make $220, so you're only going to make about 30%, 35%. In this case, usually what I try to do is make 100%. So in the case of Dollar General, that was probably a better example. So let's go back to Dollar General. So the $50 call is worth about $24.50, and let's just see what our target was on Dollar General. The target is $88. So I'm going to go back to my Thompson 1, and $88. If I pay $24.50, then this, let's say that the $50 call could be worth about 40 bucks. So that's getting close to my objective. So you can almost, theoretically, if the stock reaches the high valuation of $88, then that option should be worth about $38. So that's not a bad return. So that's the kind of thing that I'm looking for in the options. So I'm looking for something where I can almost double my money on the option. So if I invest a certain amount of money in the option, I'm really looking to get close to that level of doubling. Now I know the AutoZone didn't quite work out, so maybe I have to look at a better example there. But that kind of tells you the thing that I'm looking for. Now, what I'd like to do is at this point, I'd like to entertain some questions because I'm sure a few of you have questions. And what I'll do is I'll open up the microphones, and you can either, if you don't want to talk, then you can send a chat and we'll address your question, or you can actually send us a message in the chat box and then we'll unmute your microphone. I think that's the best way to go.
Unmuted.
Anyone have any questions at this point?
John, it's Blair. We've had one come in via chat so far, and it was from Jim, and it says, should we sell uncovered puts on purple chip stocks?
You could do that if you're prepared to own those 100 shares of stock. So there's nothing wrong with selling puts. But I'm just going to remind you of one thing, okay? I don't do a lot of put selling on the purple chip stocks because I find that if you're selling the put, you're only going to get a few bucks for that option. Whereas if you actually invest the money, usually we can make, you know, anywhere from 20% plus on these stocks, and you may end up picking up the dividend too. So it's okay, you know, for a high volatility stock, it's an interesting strategy, but it's not my preferred strategy, let's say.
And John, I think there was a follow-up from Nicholas on that. What about covered calls?
I do covered calls, and it really just depends on the particular option. So hold on one second. I have to sign something right now. What do I sign right here? Okay. Thank you. Little minor interruption there, no big deal. So anyhow, if you do covered calls, it's a good idea. Usually with covered calls, I try, and I see your question, Nicholas, I try to only go out anywhere from 3 to 5 months maximum. So I'm selling something, and by the way, I won't buy a stock and immediately sell a covered call on it, okay? Because I've done covered calls many, many times, and some of you may have seen that, well, who discussed these things with me. But what I try to do is I'll buy the stock, okay, when it's at a low valuation. Usually I let it appreciate a little bit so that at least you have something in the bank. Then you go and you write a covered call on it, okay? And we had done that, for example, with Amgen, where we did it a couple of times actually and made some pretty good money by selling options that expired actually in about 2 months. And those options, we would get $2 or $3 for them, and then they would expire. And the thing is, we selected a strike price that was pretty close to our actual target. And so if we were getting paid a little bit of money and it was fairly soon, we didn't really have any risk in doing this. So doing covered calls can be an excellent strategy, and it's certainly one that that I think is a money maker. It's one that I encourage, actually. Now, the purpose of this webinar was to talk about the idea of using long options, long calls, but doing covered calls is a great strategy. It's always been a winner. Does anyone else have any questions?
Yeah, there's a note from Brad here. It says, hey, if you want a good example, why not try the Facebook January 2018 at $90. I got in a couple months ago at 33. I hope I was supposed to
Well,
say that publicly, Brian.
you let the cat out of the bag. That's okay though. Now, I guess Facebook is a pretty good example because when we started buying these options, and the example of the unnamed person was he did something similar to what I did, and I believe we first got into the options around. I was buying the $100 calls, and the stock was about 125 at the time. And if I'm not mistaken, I paid about $30 or $35 for the calls. And now the calls are actually worth about 53. And I think that Facebook eventually will make its way to becoming a $200 stock. And here's the chart. So you can see when we were buying the stock, it was around this level over here. And of course, the stock appreciated. And so now those options have taken on some value. So let's say that, I forget exactly what I paid, but it was 30 or maybe $35, and now the option is worth $53. So this was an example where when Facebook was at a low valuation, it made a lot of sense. I didn't feel like laying out $125 for the stock that doesn't pay a dividend, so I thought, why don't I just do the options? But you have to understand that every time you do one option, you're controlling 100 shares. So 100 shares in this case, you're talking about, at the time, it would have been $12,500 US per option that you were controlling. So 100 shares. And that's not too bad. But sometimes when you get into expensive stocks like Google or some other thing, then then you can have quite a bit of leverage there. So anyhow, so that's my experience with that. Now I see another question from Todd here. Could you give an example from start to finish when you would sell the call? The example would be, I don't have any current examples. I mean, I do have, I had gotten into Amgen, and Amgen is an example where we sold an option, and we had initially bought the stock. Let me see where we had bought it. We paid $146 in December of 2016 for the stock, and so we had actually bought it around here. And I'm pretty sure we had actually sold the option the first time. We had sold an option, and it was a February or a March option that gave us a few dollars, and I sold it was either the 170s or the 175s. And we got a couple of bucks for that, and we actually collected the premium. Now, for a little bit of time, the stock had gone above the strike price, and so we were worried that we would lose the stock, but it didn't really matter. It didn't matter if we lost the stock because we would have effectively been selling the stock at 175, which would have been just perfect for us anyway. At the time, that was a pretty fast profit. And so anyway, then what happened was just before the maturity, the stock went down, because I remember the options were about to expire, or they were about to be exercised, and the day after they went down, and then they became worthless. And so we ended up keeping all the premium the first time, and then when the stock went up again, you can see, I'll go to a daily chart here, and there was a period where Amgen went from 170 up to 185, and we had sold the option again somewhere in here, and we sold the May 175 call, and we had gotten about $3 for that option at the time. Now obviously that option, because the stock went up to 184, the option was probably worth about 10 bucks at one time, but I didn't really care because I was quite happy to sell at 175 plus the option premium that I would have had, which was in this case $3. So I would have had 178. So I was okay with that. And then you can see what happened is that now the stock has gone down. I still have the option, but the option's only worth about 30 cents, not even 20 cents. And so that option, and I'm just going to give you the example, the real example here, the May option. Now, and I'm going to tell you about a little nuance about options, something you should be aware of I always go with the most popular options. There are also weekly options, and I do not do the weekly options simply because they don't tend to have the level of interest or open interest, the level of participation from people, or the liquidity that the regular options have. So I tend to not do the weekly options. So in the case of the Amgen May 175 calls, yeah, you can see these are actually at 10 cents. So I'm probably going to buy these back because there's really no reason for me to wait for that last 10 cents, because these actually expire on the 19th of May. So I still have, I've got 2.5 weeks left. And you know, with a stock like Amgen, you never know what can happen. So it is possible that that could go up again. So I'll take that profit and then take my chances. Now I see a question here from Jim. Do investors have the patience to buy long-term calls? Well, I do. Jim, I don't know. That's a question that only you can answer. Don't know if everyone has the patience to wait that long, but I can tell you from experience that it's worth it. Okay, I've had many examples where I've done options and made over 100% on them. And it has been a substantial contributor to the returns that I make. I can tell you that it's worth being patient. And if there's one thing that we've learned is that purple chip stocks tend to outperform over time. So it's worth being patient. Okay, now let's see. We've got another question here from Todd. Would you consider letting the purple chip group know when you buy and sell calls as well? Currently, we only see when you buy and sell stocks. That's a tough one. I don't want to encourage anybody to take excessive risk. I know what's involved in this, but I think we're going to continue to do this on a one-off basis, and I will let people that are interested know, or you can ask me. That's even better. You know, send me a little email or phone me or something. Most of you that have communicated with me know that I'm pretty accessible, and I really genuinely do like helping people make money. It makes me feel good and all warm and fuzzy inside. So if there's any way I can help you, yes, but do remember, okay, I'm not giving you advice. I'm just telling you what I do. So if you do something, it's at your own risk and perils, as the insurance guys say. So sorry, Todd, I'm going to be a little less direct on that one. So I may not let you know unless you ask me, because I don't want to get people involved in this that don't have the discipline to actually follow a plan well, because it is risky. Does anyone else have any questions? I hope I've answered everybody's questions. Actually, I see I missed one here. Judy, do you look at the delta to pick your strike? If so, which delta, 80%? The delta is another word for how much an option moves relative to the stock price. And I suppose I do indirectly. Yes, I do look at the delta because I look for deep in the money options. I'm looking for an option that's going to move pretty much one-to-one with the stock price. And that's what keeps the risk low for me. And I'll throw in one other thing here. I don't want to get too advanced on this, but when you buy a call option, it's almost like you have a built-in stop on a stock. And I'll give you the example of AutoZone. This is a great company, but what if something really bad happened in AutoZone? You have one option, you've spent, I don't know, $15,000 US on this. If you had the stock and you had 100 shares of stock, you would be spending about $70,000 US. Let's say that hypothetically that stock goes and drops by 30%. Well, all of a sudden you're off by $200 a share, let's say, $20,000, but with the option, you actually have a limited risk. So that's one of the benefits of doing an option over the stock price. Now there's a little risk premium in there because you're paying over the intrinsic value, but it is certainly something that's not lost on me. You know, I like that idea of having a built-in stop. I'm just trying to see if there's any questions I did not answer. I think that pretty much covers it. Yep.
So John, I think there's a couple more. One from Nicholas, and then one from Jim. So if you buy deep in the money, buy a deep in the money call, do you have a target to exit at a certain percent?
And then I never ever use the percentages. Okay, that's and anyone who knows me well would know that we always base it on the target for the purple chip stock. So if you buy an option, it's the same as if you're buying the purple chip stock. Okay, it's the same as buying the stock, so we follow the same targets. So I don't say, well, I just made 30%, so I want to take the profit. That's a really bad, it's not a good idea. Okay, you're going to leave a lot of money on the table if you do that. Okay, so I think that was from Nicholas. So I don't look at the percentage that I'm making because I think it's irrelevant. I think what matters is whether the stock becomes expensive or not. Jim is asking if my clients deal in options. Yes, all the large ones. So the answer is, and I'll tell you what the rule of thumb is, Jim. Anybody who has over $500,000 with me, I automatically encourage them to have well, in fact, we open an options account and I make the decisions for them. So I know this webinar is not about the way I manage or, managing your money necessarily, but that's what we use. So accounts that have portfolios that have over $500,000 with me, we automatically do options, and so we do covered writing. We don't necessarily do the leverage aspect unless it makes more sense. Some clients will request that, and so that's kind of on a one-off basis. I'll do it if they have the risk tolerance for it, but I am aware that doing options, it's a risky proposition, and you have to understand the game that you're in. I know what I'm doing with options. I do it for myself, and I'm prepared and understand that I can lose, 30, 40, 50% on a bad option deal. But I also know that, in many cases, I've made quite a bit of money. And I actually have a fun story about this. And I haven't told this to a lot of people, but my kids had an RESP, and one day my assistant says, John, you've got $140 left in this RESP. We had drawn most of the money, and she said, do you want to take it out? I said, yeah, sure, just write me a check, And anyhow, she said, oh, sorry, you know what? You can't take it out because there's going to be some kind of you're going to have to pay the government because you got subsidies on this thing anyway. So I didn't take it out. I said, okay, I'm going to invest it in options. And so I did some purple chip stocks on it, and in the space of 2.5 years, I turned that $140 into a little over $15,000. So now the kids have TFSAs that have been funded, and it's all thanks to some good option strategies. So I think that's kind of fun to get that kind of leverage. I mean, it's pretty amazing to make $140 turn it into $15,000. And my goal is that one day if I can turn that into a house down payment for each of them, then I think they're going to be pretty happy with their dad. So anyhow, that's my little story for you.
So John, I think we're all looking to be adopted, but Todd's got a question. but Todd's got another question about the recent purchase of Smuckers and whether that's something you would have bought options for.
Actually, it is because I did it. And I'll tell you which one I did. And the Smuckers is around the same price. And let's see, I'm going to go as far out. I like to go as far as I can on the options. And so in this case, let's look at the January 2019 $100 call. And in this case, you've got an option that's trading, let's say, about $28. And I think actually the 28.40 might have been me. So the last trade was 28.40 on the 25th, on April 25th, and I'm pretty sure that was my trade. And so you can see that the option is still worth about the same thing because the difference between the midpoint between the bid and the offer is about the same. So this is one where I bought the option, paid about $28.40 for it. I know I did actually. I paid $28.40. And my estimation is that in the case of Smuckers, JM Smucker, let's see, we've got a target of 149. Okay, and we have got 149. So if we go to 149 on the stock, then let's assume that that option will be worth $49. So that's almost a double. So that's kind of what I was insinuating, is that that's the kind of option that I'm looking for. So I've got a limited risk. I am not going to get the dividend that gets paid by Smucker. So I'm leaving some money on the table there, but I like the leverage factor. So in a case like this, you know, I'm quite happy to buy whatever, X number of options and ride the option position instead of owning the stock. So there you have it. Any other questions? Judy is asking, do I ever buy protective puts? No, never. I don't do that because I don't believe in it. I think there's only one way to go with a stock, okay? Either you own it because you believe it's going to appreciate, or you go and you sell it because it's overvalued. So the idea of buying protective puts doesn't appeal to me, and I think that based on my experience, every time that I've done this in anticipation of thinking that there might be a correction, it's usually been an expensive proposition. So I don't do protective puts. I'd rather just be more conservative, go with good quality stocks and make money on them. Because I think in the long run, as you've seen, because I know you're one of the people who appreciates what Purple Chips has done for you, in the long run, I think you're much better off doing that than trying to second guess corrections in the market. Are there any other questions? Did I get them all, Blair?
You sure have, John.
Okay, well, I think we're going to wrap it up then. And I want to thank everyone for participating in this. It's a lot of fun to talk options. It's a subject that I'm very passionate about. And of course, making money with Purple Chips is always a lot of fun to talk about. So if you have any more questions following this, we have recorded this webinar. And so you should be able to see this on the website in a couple of days. But if you have any more further questions after this, then don't hesitate to reach out to me. So thanks for joining in. And I'm John Schwinghamer, the author of Purple Chips, signing off and wishing you a great day. Thank you.